Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and I'm so delighted that you can join us once again today. And we have some valuable information to share with you today. And we are going to take a look at the major inflationary contributions to the current U.S. housing market. And we have an expert with us today who has a tremendous amount of knowledge in conjunction with this. Dan Erb acts as the managing partner at EM Capital, an investment platform built through partnerships with local professionals and providing an alternative to traditional real estate investments for limited partners. Previously, Dan was an M&A professional, primarily working on the sell side with founder-backed businesses and private equity firms. Most recently, Dan served as an investment banking associate at Brown Gibbons Long. Dan also has experience working in wealth management, deal advisory, and strategic consulting at companies based in San Francisco, New York, and Hanoi. So, Dan, we're so happy to have you with us today. And take us into the show and just give us a little bit of your background here. And as you were sharing, you are a teacher in a number of different areas here. So tell us a little bit about that.
Yeah, absolutely. Well, thank you for having me on. And I guess I'll get started with what led me into real estate and some of the things that I'm doing now as well, including teaching. So back in 2021, I was an investment banking analyst, and if you're not familiar with what the day-to-day life of a investment banking analyst is like, you work a lot of hours. And that was something that I was really excited about, and I definitely took advantage of. So I was expensing a lot of meals on my weekends. Wasn't spending too much money, had a small little studio apartment right by my office. And I got my first investment banking bonus, and I wanted to invest in real estate. I was a former CPA, and I knew about some of the tax advantages. And then as well, that real estate is a great vehicle to build wealth. And so when I was thinking about what exactly to invest in, I was lucky enough to have a very close cousin of mine, almost like a brother, who was working at BlackRock at the time. And I gave him a call and told him that I was sitting on some money and I wanted to deploy it into real estate and wanted to pick his brain about it. And he comes from a background of equity research, and we put our brains together and we identified this structural undersupply of single-family homes that was caused by the Great Financial Crisis. And it really wasn't until we laid out the supply of homes that were coming to market, which is trackable through housing starts, versus the demand for single-family homes, which we based off of generational factors such as home ownership rate as well as population growth. And you could double click into markets for this supply and demand trend. And having spent 5 years at Indiana University pursuing an undergraduate degree in accounting and then MBA with a concentration in finance, I was flying into Indianapolis every year, twice a year, 3 times a year, from 2014 to 2019. I just saw how much that city was growing and developing, and I was really attracted to that. And when you combined it with the research that we were doing in terms of the supply and demand characteristics, we felt that buying a single family home in Indianapolis would be a great investment. We bought our first home, and there were some problems as an out-of-state real estate investor. We felt that the incentives weren't necessarily aligned between real estate brokers, property managers, and then us being investors. And so I looked at some of the ways that private equity firms were rolling up physician practices. And I was working in the healthcare and life science team, and I applied some of those principles, such as rollover equity, to single family real estate. And so once we figured out a way to better align incentives and to lean on local insights of people that are doing this on a day-to-day basis in terms of walking properties, finding tenants, selling homes, we've kind of taken off since then, where we went from one property in January 2022 when I left investment banking full-time to now 15 properties across Indianapolis, Chattanooga, and Birmingham. And so, to kind of summarize what we believe in, our principles are good business leads to more good business. And, we think by providing these equity incentives to local real estate professionals, combined with institutional research in terms of the markets we're selecting and asset classes we're targeting, we could kind of stack up a few different factors that really drive strong returns. And so far, our performance has been, really, really good. And so we're looking to continue this growth and really excited about the opportunity to talk more about it.
Well, sounds very fascinating and well analyzed and certainly well researched. And so I can see why it would have positioned you an excellent position there. Tell us, Dan, a little bit more about the incentives that you have developed for essentially everyone involved in that process, from realtor to property manager to investors.
Yeah, so we have a very investor-friendly structure when it comes to the fees we're charging or promotes, and that's because we participate as LPs. And so for folks that aren't necessarily familiar with the LP GP structure, the way it works is that LPs typically get a preferred return, meaning that they are getting paid back first at a certain rate. After that preferred return is reached, then the excess profits get split a little bit more favorably towards the GP. And so it creates this model of when the investment goes really well, the GP makes a lot of money, the LP makes a really solid return. And a lot of private equity real estate businesses are structured in a way where they're charging fees up front and then as well throughout the deal. And that's really to keep the lights on and to be able to pay the folks that are working internally for them. And so with our strategy of buying out of state and wanting to play the role of capital allocators, we needed a local operating partner. And so instead of having a broker who is sending us properties, walking them, telling us what they think what they think they can rent the place for, what needs to be put into the property in order to make it rentable, and then kicking off to a property manager who actually has to execute. We wanted to work with one person that was going to both serve as our broker and our property manager. And what we found in talking to a lot of these local brokers is that they feel that investor clients almost work against them sometimes. And we wanted to empower them. And I think a big part of that is that we know what we know, and we know what we don't know. And so we wanted someone that was living in the markets we were investing in, passionate about real estate, passionate about single family homes. And instead of paying them a typical 8 to 10% of rents as a property management fee, we wanted to provide them equity in the deal that vests over the course of the investment horizon. And so this was something that was pretty novel. to the asset class. But once we started putting it on paper and marketing it, we found that the highest end of talent, folks that really believed in what they were doing and felt like they wanted to bet on themselves, were the people that were most excited about this kind of compensation model. And so we really believe that we want to be the first person called when a great opportunity pops up. And so in investment banking, we used to say, we're thinking about your deal when we take a shower in the morning. We're thinking about your deal before we go to bed. And we wanted someone that was going to be local in the markets, that was thinking about us in that light. And so since switching to this type of compensation model, what we found is, one, we are buying single family homes at a rate of 90% below appraised value. So out of our 15 properties, 13 of which were bought below appraised value, some as much as 15 to 20% below appraised value. And in the single family world, that only happens 2.5% of the time. And then we also seamlessly lease these properties, because the rental assumptions that we're getting for underwriting and our expectations and our ability to identify a deal that provides strong cash flow that's maybe undervalued in the market, is really strong. And we want our local partners to give us the most conservative assumption possible. And their equity compensation is based off of how quickly they're able to rent these properties out in year one. And so that's a kind of high level overview. But again, I think to summarize it, it's that good business is going to lead to more good business. And so we would rather create this win-win situation versus thinking of it as a zero-sum game.
We are talking with Dan Erb, who is an expert in finance and in particularly an expert in out-of-area single-family investment opportunities. You can find Dan at emcapllc.co. Well, Dan, let's take the conversation a little different direction here. And the Consumer Price Index report has come out recently here. And based upon that, what do you see as some of the primary causes of the inflationary pressures that we are seeing in the U.S. housing market?
Yeah, no, that's a great question. And it's something that we've been tracking for a really long time. So back in 2020, 2021, everyone started hearing about inflation and how it was hitting the economy soon. And, the largest driver of inflation has been shelter costs. And so CPI is made up of a number of different factors, but the largest factor, or 40% of CPI, is shelter. And so the way that the Fed tracks shelter is by looking at what are rental rates in a market, and then as well for home ownership, they send a survey that says, what would you be able to charge for rent if you moved out of your property? And the reason why we've seen such strong growth in terms of rental rates in single family homes in particular, because there's this structural undersupply of homes that following 2008, 2009, when we clearly overbuilt, and then the rug kind of got pulled out from us. The government changed the incentives of developers. And then as well, a lot of people made a bet, in a sense, that multifamily was going to be the millennial single family home. That millennials wanted to live in condominiums or apartment buildings. And I think, speaking firsthand as being a millennial, that's not necessarily the case. Yes, we're not having as many kids, but that doesn't mean that we don't want a backyard, or we don't want to have a starter home or live the American dream. And we're now getting to a median age of 31, 32. And millennials are 90 million strong. We're the largest generation in US history, and we've bought single family homes at a relatively low pace compared to Gen X and boomers. And at the same time, for the past 10 years, we've significantly underbuilt. And in fact, in 2009, 2010, US housing construction retrenched the levels not seen since 1960.
Wow.
And so there's this really strong macro factor across the US of this undersupply of single family homes, while at the same time, millennials are getting to that age of 35 where home ownership rates significantly change. And so when I saw this, this was something we wanted to really go after. And with inflation increasing, we've seen the Fed try to decrease this through increasing rates or increasing interest rates, making the cost of capital significantly higher. However, when you break down the most recent CPI report, which showed year-over-year inflation of 3.2% and 0.4% month-over-month, the key driver to that increase for the past 12 months has been shelter costs, which has climbed close to 6% year-over-year. And within those shelter costs, single family inflation is, almost double apartment or multifamily inflation.
Mhm.
And so, we believe that this trend will continue, and it's something that even Jerome Powell has addressed in the last few Fed meetings, where he said, "Look, we haven't built enough single family homes. There's nothing we as the Fed can do about that." And so, from our view, the last 2 years or so, when interest rates started climbing up, and a lot of people were telling us that housing is going to crash like it did in 2008, 2009. We had strong conviction, and we were steadfast, and we were growing in a time period where not a lot of people were.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. So that's interesting to me. I guess one of the first questions that comes to mind is that, like you say, the millennials are reaching midlife, 35 years of age, and that is a peak period of home purchasing. And yet the shelter costs on average have increased about 6%. Single family homes, you just mentioned, have doubled that. So that's about 12% that single family homes have increased. So there is a shortage, and so there is a shortage of supply, so there is a lot of demand. But how can millennials purchase these homes at these very inflated prices? I mean, there's a cap on how much capital they have to put into housing.
Yeah, I think that that's a really good point. And there's a reason why there's so many people on the sideline, or there's so much pent-up demand right now, because affordability is a major issue. And part of the reason why we picked markets such as Indianapolis, Birmingham, and Chattanooga is because of the affordability in these markets, which provides extra liquidity. And so you probably aren't going to be able to buy a single family home if you're the average millennial in a coastal city. But when you look at the Midwest or in the Southeast, there are very desirable properties that most folks would be able to afford. And so Indianapolis in particular, if you look at median income in Indianapolis, it's about the same as the US's median income per capita. And you compare that with housing prices, though, and Indianapolis is 25 to 30% cheaper or more affordable.
Mm.
And so I think for millennials that are seeking to buy homes, you may need to rethink in terms of what market you are seeking to live in. But there are really great jobs, and I think that the working from home trend is here to stay. Maybe not to the same scale or in the same way that it was during COVID, but that there are a lot more remote jobs out there. And so folks that are, seeking to live in a starter home, a 3-bed, 2-bath, or even a bigger home that can eventually fit a family. And my advice would be to, look in some of these these underappreciated markets, where there are really strong jobs. There's a lot of amenities, that, I think investors historically have kind of ignored.
Yes, and of course, I mean, there are strong jobs and amenities, and these are growing and thriving cities, but they aren't necessarily climate-wise that attractive, and recreational opportunities and different things like that are kind of missing in those areas as well. So is the job attraction enough to continue to draw people to these when they have a choice whether to work from home or in the office? Or what are you saying in conjunction with that?
Yeah, so the local economies, the things we look for are strong healthcare and academia industries. And so across our 3 markets, there's really strong healthcare and academia industries. But I would disagree with you in terms of the lifestyle. So Chattanooga is a market that sits in between a valley and Tennessee. It's near Atlanta, it's near Birmingham, and it's a 2-hour drive to Nashville. You can go hiking, whitewater rafting, and water skiing in the same day in Chattanooga. There's also in Birmingham and Indianapolis. These are cities that have a lot of different nightlife activities and sporting events to go to and concerts, and I think that they provide comparable amenities. I am from New York, and I've lived in Chicago, and I've lived in San Diego, and I'm not trying to say that they're the same, but that you can still very much so have a great lifestyle or a great work-life balance, and have things to do on weekends within these markets, and so that's something else that we value is having these downtown amenities, because I do believe that that's what folks want.
Yeah, I certainly agree with you on Chattanooga. I don't live that far from Chattanooga. It is certainly a beautiful location and a very wonderful climate. And what about Knoxville? Have you?
Yeah, no. So I think that for now we have operations streamlined within these 3 markets, where we have a database of hundreds of deals that have been underwritten that's being updated every day based off of MLS searches. We have local partnerships with folks that give us a call when an off-market opportunity pops up, and so there are more deals than we have capital within these markets. Eventually, and something that we are looking to do in the near future, and if you follow us on LinkedIn, you'll see us post about Knoxville in a couple weeks, is to keep expanding into more markets. And so Huntsville is a place that we've identified, Knoxville, Greenville, South Carolina. There are more places that we believe provide similar benefits to an Indianapolis, Chattanooga, and Birmingham, across the United States. And we hope in the near term we could go from 3 markets to 10 markets, and maybe 10, 20 years from now, be spread out across the U.S.
Sounds like some exciting plans, and not just exciting, but well analyzed, well thought out, and very strategic in a lot of ways. I would say you're probably on a course of success. And as you say, good business leads to more good business, and good business leads to good and loyal investors. And once again, we are talking with Dan Erb, and you can reach Dan at, tell us, Dan, where we can reach you.
Yeah, so you could go to our website, emcapllc.co. We're also we have a decent presence on LinkedIn where we post almost weekly, and this is because one of our fundamental principles as a investment platform is that we're constantly doing research in terms of the asset class, in terms of the markets we're investing in, and the different sub-markets within those markets. And so we posted a January CPI recap. We posted a February CPI recap. We'll also be talking about the NAR settlement, which is going to have some major ramifications to traditional residential real estate brokerages. And so I think you should also give us a follow on LinkedIn. EM Capital is our profile for that.
Well, just to take us out here, and you just mentioned the NRA recent settlement. Just give us a recap of that.
Yeah, absolutely. So the settlement for the NRA is that basically on March 15th, there was a court agreement where people have sued the national real estate brokerages for antitrust issues, where on an MLS listing, so on a Zillow, on a Redfin, if you look at a property, seller commissions were 5 to 6%. And when you buy a home, you use a broker, and then this commission is split and it comes out of the seller's pocket. And so and this isn't necessarily come into action. It's expected to come into play closer to the summer. But what will happen moving forward is that a seller is going to be able to negotiate their own fee arrangement with a broker. And then the buyer is going to need to negotiate a fee arrangement with a buy-side broker, or alternatively, avoid using a buy-side broker altogether. And that way you're not paying a 5 to 6% fee, even if you aren't using a brokerage. And so it's going to bring down the cost of transactions, which will provide more liquidity. And liquidity is one of the major factors that drives valuations. And so I think it'll be a net positive in terms of transaction volume. However, I don't know exactly the implications. And I think if you look at Open Door or Redfin or some of these larger places that make a lot of profit in terms of this 5 to 6% listing fee, they've come out and said that for the most part, they believe that'll be a net positive for the industry. But it is kind of reshaking how real estate agents' compensation is going to work, especially on the buy side, where you're going to need to negotiate with investors or first-time home buyers what exactly your commission is.
Well, in terms of your business, since you are providing equity rather than commissions, it's probably not going to have much effect on your business, is my guess.
I hope. I think that if anything, it'll make us even more desirable.
Mm-hmm.
And I think that we'll have when we do expand to our next market, we'll be able to be extra selective in terms of the talent we're working with. And so I think that it has some positive effects for us, but it's too early to say in terms of how big of an impact it will have to our business.
Yeah, it's change is always uncertain, but yeah, it looks to me like it's going to be a good deal for you all. And I wonder if your example might not be setting a trend for particularly brokers who are working with investors. If I were still doing brokerage, I would certainly be interested in that over a commission, for a number of reasons. It's probably going to be much more valuable as equity, and it is also providing long-term income rather than just one shot in the arm. So yeah, a lot of advantages there, I would think, from a brokerage perspective, but it is challenging to bring about change. So yeah, it's difficult for people to see a new way, even if it's better for them. Well, Dan, it's been wonderful having you with us today. A very insightful conversation. And enlightened investors, thank you so much for being with us. And I hope you've enjoyed today's show. And please take a moment to like, share, and subscribe. And head over to your favorite podcast app. And we'd be most grateful if you would leave us a rating and a review. Until next time, live abundantly. And we'll see you in the next episode. Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.